Financing Fridays. Hello and welcome to the Froggy Five podcast. I'm Jim Froehlich, your host. I'm founder and managing member of the Froggy Companies, and I'm happy today to be joined by my good friend Colby Bowers. What I kind of want to close out with is something that's not as exciting as the best deal ever, but it's something that's critical and I don't think people get enough of on this front, and that is just financing, like a drill down on financing. And what I want to ask you is like what you're doing to overcome the hurdles of financing today that we all know and experience, whether it's a debt or equity or something you've done creatively, either what you're doing there or something you've done creatively to accomplish something in the past with real estate.
Yeah, especially these days, like you said, financing, especially debt through banks and stuff, is a little bit more challenging. Just with inflation, higher interest rates, trying to get the numbers to work. It's what you and I are doing. We're starting a fund that we can collectively have money pulled together and ready to go when those opportunities come about. And I think the other thing that's great about having a fund is, it allows the investors to diversify. Because that's the other challenge with going to investors is they're like, with interest rates, inflation, the uncertainties of the market, they don't want to just invest in one deal. And they don't want to put all their eggs in one basket. So I think
Exactly.
allowing in that opportunity for a diversification, still in the real estate, they still get all the same benefits as if they own the property, taxes and stuff. But it's kind of they're looking at it as a mutual fund for real estate, and so that's we're seeing a lot of at least from the raising capital, which makes it easier then for me and the operators to go and deal with the banks because the banks are creating, they're tightening the purse strings a little bit. So there's a little bit more things that we have to, little hurdles to jump through. And I wouldn't say barriers, but, they want to make sure that we're capable of doing what we're doing. The other thing that we're also looking at and having some success is looking at some smaller deals to where I call it mom and pop, but where it's kind of just a older, couple that they own, smaller multifamily, maybe 10 to 25, 30 units, want to retire. Kids don't want anything to do with it. They want to sell, but they don't want to go through a broker because they don't understand the whole commission thing. And, so I've worked 2 deals here in the last year that we've able to generate some owner financing or some carryback from the
Sure.
owner, which it works in their favor. One is we get to keep the broker out of the deal, work directly with the seller. A lot of times it's less money we have to bring. We may not even have to bring the bank with us. They may hold the note. We just bring a down payment. That's typically smaller than what we would need on, a traditional purchase. And plus, the win for the seller is they get to kind of spread out their tax burden over a couple of years instead of taking that, large capital
They gain
gain
all at
on
once.
whatever their
Sure.
profit at once. So, it ends up, it goes back, like you mentioned, is problem solving is, how do you create that win-win? Talking to folks, what do they want in their deal? And that's, I've won deals in the past that I didn't have the best offer, like dollar amount, but I had the best terms because I took into account what the sellers were wanting to do, whether that be a fast close. More than likely, actually, it's been a delayed close. They're like, "Hey, I wanna sell it. I'll sell it to you now, but I wanna wait till after the first of the year to sell because, my taxes or whatever," and that may be, 4 or 5 months down the road. So if you can maintain that flexibility and again, problem solve,
Sure.
a number of deals out.
Absolutely.
So
I just got somebody brought a deal to us yesterday from in Idaho, and the broker told me, yeah, the seller, she's saying she's open for owner financing. Like like 100%, but at 12%. So I was like, had to think about that for a minute, right?
Yeah.
Because most are hearing like, okay, well, that might be the going rate on the large commercial property in Idaho. So most of now with when the higher interest rates jumped, a lot of other people doing owner financing are like, okay, I can just get 10%, yeah,
More.
9 to 10% easy because people are getting a better deal with me for a portion of it. So that's good. Thanks for covering a few of those. And like you said, the diversified fund. Yeah, I'm reading that Tony Robbins book, that latest book of his called The Holy Grail of Investing.
Mhm.
And he covers, I think the Holy Grail goes around, private real estate, private equity, and private credit is sort of the three areas. And he talks about diversification and how something that I notice, and I'm not smart on investing in stocks and stuff like that at all. I think I'm really real estate focused, but he talked about non-correlated investments in diversity. And I think that what I've been thinking lately is that you could do that within a real estate portfolio
Mhm.
so things don't go up and down. Because when you look at these public REITs and stuff that are they're basically, real estate's supposed to be a diversification, right? They've said historically, make sure 20 to 30% of what's in your portfolio is real estate along with your stocks and bonds or whatever. But now that you have stocks and bonds are becoming more correlated, at least the last times they both dipped, the same thing with REITs, with public REITs, because they're almost like over diversified, right? These large super funds, they don't need to make a lot. They're like, oh, we did 9 or 10%, and they're like happy with it because they're making just tons of money every year, right? If you have $1 billion, you could just keep making more money, and you have a lot of mouths to feed, so you're out there just doing deals, which and and I think that not enough attention is being paid to the correlation within that. So the public REITs are actually going down the same time stocks go down. So it's becoming more emotional based, where typically illiquid real estate is not.
Yeah.
So real excited to talk more to you about diversification on the creating financing side with a fund, and then like you said, the owner taking back some in the form of note. That was like the first lesson I learned from Carlton Sheets in the '90s when I had no money at all, and I was like seeing this guy in an infomercial, like, hey, get on the phone, find out what the seller's needs are, and if they're willing, why are they selling, and if they're willing to take back some. And so it's still working. You've put it into use really well lately, as you just said. So
And I
that's
want
awesome.
to I want to touch. You brought up a really good point. Talking about REITs, and I've had and actually in the last couple of days, I had two conversations about REITs with some potential investors, and you know, a lot of investors out there love REITs, and I think, and the re and the commonality seems is because they can be in and out. Um, but after talking to them, what people don't realize with REITs, and you said it right, they have hundreds of millions, billions of dollars into these REITs, and there it's quantity versus quality versus like what we're doing, smaller fund, in case by case, we're looking for quality, not quantity. And
Exactly.
and so because we're looking for, we're not going to be happy with, our investors just getting a 9%, annual return. We want that, 18-20% that we know is out there from previous performance. And yeah, so just people need to realize it. Just yes, REITs are great. You can be in and out, but if you're really looking for long term wealth gain, um, I don't I I'm not a huge fan of REITs anymore because of that. I'll go and put it in a mutual fund and can get the same returns as
Yeah,
a
just
REIT.
might as well have it in an index fund if you're going to put in public. And that's I
Right.
say that while my original vision was being a large REIT, the Froggy REIT. We were going to be safer, kinder, friendlier living with a very specific plan to grow my own mega empire. It's at some point you get diminishing returns. You have flexibility to just get deals done, but does your underwriting start suffering because you have to keep buying, right? No matter what, you have to. So anyway, well, you and I can pontificate that as we select the assets for our upcoming fund. I really appreciate you coming on early, being essentially our first guest on this kickoff of this new podcast format. I'm going to restart the podcast for Patriots with just military veterans. I'm putting you on the Froggy Five this time. We may go back to the other format later with you as well. You're such a good guest. So I appreciate you taking the time, Colby, and I'll talk to you next time. Thanks, man.
Thanks, Jim.
Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. We also have the Froggy Fund 1 that's now open for up to $18 million. We're going to be investing that $18 million across a diverse number of assets, cash flowing and ground up. And I'm really excited about this fund and really confident that we can outperform most of the other people out there in terms of what we invest in and how we do our due diligence and the type of partners we put together. So it's great talking to you, and see you next time.